Welcome back. We're ripping through the institutional blueprints today, the kind of proprietary reports that tell us what big money is really doing.
That's right, especially when the headlines are just screaming, "Nothing to see here."
And we're focused squarely on late November 2025. The consensus sentiment right now is, well, it's frustratingly neutral.
It is, and when the market's directionless, the best insights, they're not in the news flow, they're found in the plumbing.
So that's our mission today. We want to extract actionable knowledge. How is institutional capital monitoring liquidity? How is it spotting structural risks? And where is it finding alpha?
Across the whole futures complex, ES, NQ, RTY, and of course volatility.
We're looking right past that neutral facade. Because the real action, we know it's in the structural dynamics. You have to understand the pre-market mechanics. That's what sets the tone.
It all starts there. Institutions begin their day with a deep scan of the pre-market order books. It is all about assessing depth before that opening bell rings.
So why focus so heavily on bid-ask spreads when the volume is, traditionally so low?
Because that asymmetry gives you an immediate read on conviction. Spreads are naturally wider in the pre-market, of course.
Right.
But if you see abnormal, sustained tightening, that can signal aggressive positioning. It means someone important is moving in, and they don't have the patience to wait for the open.
It shows their hand.
Exactly. It shows conviction. And conversely, excessively wide spreads, that's a major warning sign. It suggests a total absence of natural two-way flow.
A brittle market. One that's highly susceptible to dislocation right after the open.
Precisely. And beyond just the spread, the desks are analyzing the actual depth of market, the DOM.
Okay, so what are they hunting for in that stack of orders?
They're searching for the accumulation of large limit orders. These blocks they're tactical anchors.
So they act as either magnets, pulling the price toward them, or barriers.
Formidable barriers, yeah. Places where the price is just unlikely to move past without some kind of major catalyst, and identifying those levels it's foundational.
And this is where it gets really insightful. The idea of stub quotes. This is a more advanced concept, but it says so much about the market's real structure.
It really does. Stub quotes basically mean an absence of depth. When systems scan the book at levels far away from the current price and find nothing. Just a few fake limit orders.
It signals dangerously poor liquidity underneath.
That's it. If the market suddenly needs to sell, there's no depth there to absorb the flow.
So if you see stub quotes, is that purely a risk signal, or can an institution actually capitalize on that fragility?
It's primarily a risk signal, but it absolutely informs capitalization. I mean, if they see that the path of least resistance is thin, they know that even a modest push in their direction can create an outsized move.
So they won't just pile in, but they'll use it.
They'll use it to aggressively defend or exploit key short-term pivots because they know the price will move easily once a barrier is cleared. It's a structural vulnerability they track constantly.
Okay, so we move from the microstructure of the order book to the macro signal of fear, the VIX. Spot VIX is moderate. It fits the neutral headline narrative. But we know the VIX term structure tells the real story about risk over time. So give us the quick 101.
The normal state is an upward sloping curve. That's Contango. You pay a bit of a premium for volatility risk further out in time.
Then the alarm bell.
The alarm bell is backwardation. The curve inverts. Near-term contracts trade higher than long-term ones. That signals immediate, urgent market stress.
And here's the paradox, which our sources confirm. This classic fear signal, an inverted VIX curve, statistically, it often precedes positive S&P 500 returns.
The fear is already priced in. Thesis.
Yes. Yeah.
Exactly. The panic has peaked and the markets may be getting ready to rally.
But what we're seeing right now, late 2025, it's more complex than just contango or backwardation.
Far more complex. We have a moderate spot VIX, yes. But the term structure, it shows a flattening front end. That suggests near-term hedging demand is quietly rising. And critically, we're seeing a visible hump in the mid-curve.
Those 3 to 6 month contracts.
That's right.
So a hump means institutions are pricing risk higher in the middle of the curve than they are near-term or way out long-term. What kind of uncertainty creates that?
It points to underpriced tail risk tied to specific, known, intermediate-term events. So think about potential for a major Fed communication shift, or maybe the market positioning for the first glimpse of election cycle uncertainty in early 2026.
So the market is calm today.
But it knows serious volatility catalysts are lurking, and it's systematically underpricing them in those intermediate contracts. That makes a risk-reward appealing for buyers of that midterm vol. It signals a caution that spot VIX just doesn't capture.
Okay, so if the VIX is signaling potential future stress, correlation breakdown signals structural weakness happening now.
And this is where we look at the futures complex, ES, NQ, and RTY. They should march together. When they don't, it means capital rotation is already happening under the surface.
Right. We often see the NQ, the NASDAQ, leading a rally. But if RTY, the Russell 2000, which is our best proxy for broad economic confidence, if that lags significantly, what does that narrow breadth tell us?
It tells you the rally is defensive. It's not cyclical. Investors are prioritizing liquidity and, very specific growth narratives, AI, certain tech leaders over broad economic health.
So a weakening RTY during what looks like a bullish ES rally.
It strongly indicates a subtle risk-off rotation hiding within the bullish tape. The market is getting thinner, less diversified, and ultimately more fragile.
To really get the full picture on those capital flows, institutions broaden this out. They use that cross-asset framework with the classic triad. Equities, the U.S. 10-year yield, and the dollar index.
The US 10Y is your real-time inflation and growth thermometer. The DXY, the dollar, that's the ultimate global safety net. And equities, of course, are the risk gauge.
So let's run through the two classic scenarios. Scenario 1. Falling equities, falling U.S. 10-year yields, and a strong DXY.
That is the textbook definition of a classic flight to safety. Money is fleeing risk from equities, and it's fleeing duration from bonds.
And they're selling everything to raise dollars.
Which is why the DXY is so strong. It suggests immediate systemic fear.
Yeah.
Deleveraging.
Okay, now the more complex one. The one we see when rates expectations shift. Rising equities, falling U.S. 10-year yields, and a stable DXY.
That screams growth scare. Or you could call it disinflationary risk on. Growth is being sought, which is why equities are rising.
Yeah, without the inflation pressure, that would push yields up.
Exactly. So money is chasing duration and quality growth. You can almost hear the panic buying of quality growth stocks as money flies out of commodities and into highly liquid tech.
And where do alternative assets like gold and Bitcoin fit in? What if gold is falling with equities, and we still see that strong DXY when the traditional safe haven fails?
That is the most concerning signal of all. When gold, equities, and sometimes Bitcoin all fall at the same time while the dollar rips higher, it just overrides any specific narrative.
It's not about inflation or safety anymore.
No. It suggests a non-discriminatory systemic deleveraging, a forced liquidation event. Participants are selling everything to meet margin calls. It proves that in times of extreme stress, liquidity is king.
Which brings us to tactical execution. How institutions exploit that structural weakness, this idea of trapped traders. How do you even spot them?
You look for what's called a failed auction. These are swift, immediate reversals after the price breaches a key overnight level, say the previous day's high, and then it just snaps right back below it.
So the breakout fails.
It fails.
Yeah.
And that suggests that the aggressive buyers who chased that breakout move, they've been absorbed. The market is now moving aggressively against them. They are trapped. Their only goal is to cover their losing position.
And the mechanism to exploit them is the liquidity grab, the stop hunt. This isn't passive. This is deliberate.
Entirely deliberate. Large institutions will intentionally push the price just past an obvious level to trigger all those clustered stop-loss orders.
And those forced orders generate the liquidity they need.
Exactly, the liquidity they need to enter or exit their own huge position at a much better price.
Is there ever a risk that this stop hunting tactic, that it backfires on them?
Oh, absolutely. If the institution pushes too hard and there's unexpected real depth hiding just past their target, or maybe a news event hits at the same time, they can ignite a move that runs away from them.
Which is why they have to be so precise.
And it's why it's often layered in. But the visual confirmation you need to see is that sharp reversal, that long wick on a candlestick chart. That confirms the price spike was just a grab for liquidity, not a true change in conviction.
And all this tactical execution, it relies on some pretty serious technical rigor, specifically the calculation for the implied opening range.
Right. The futures fair value calculation. It's so much more important than just where the futures are trading 5 minutes before the bell.
Why is that?
Because the calculation provides a mathematical anchor. Futures fair value, or FV, it uses the prior day's cash close and adjusts it for the cost of carry.
Okay, so that's interest rates, days to expiration, and dividend yield.
Exactly. The formula gives you an unbiased, theoretically sound view of where the index should open. So if the actual pre-market futures are trading way off that fair value, it immediately flags a misalignment.
A misalignment driven by something that isn't fundamentals.
Right. Could be overnight emotional trading, could be a big block getting positioned. Spotting that deviation is the first step in spotting alpha.
Let's step back for a moment and look at the macro engine that's driving all this.
Yeah.
The picture is pretty mixed. Sticky core services inflation.
And a Federal Reserve that's really pushing back against any talk of early 2026 rate cuts. The higher for longer narrative is still very firm.
The ambiguity seems to be the main problem. We have this bifurcated labor data, resilient initial claims.
Meaning mass layoffs aren't happening.
But rising continuing claims, which suggests if you do get laid off, you're struggling to find a new job.
And that ambiguity keeps the Fed data dependent. It prevents any big directional policy shift, which in turn forces the market to focus on these little divergences we've been talking about.
This uncertainty then leads directly to the issue of systemic fragility. Tell us about the subtle liquidity drain the sources are highlighting.
This is the hidden danger. It's a combination of ongoing quantitative tightening, QT, which is just quietly draining bank reserves.
The slow bleed.
The slow bleed, exactly. And reduced dealer balance sheet capacity. And this constraint comes directly from post-Volcker rule regulations.
For listeners who don't have the Volcker rule top of mind, what's the core constraint it puts on dealer balance sheets that makes the plumbing so vulnerable?
Simply put, the Volcker rule and other capital requirements, they raise the cost and the risk capital needed for dealers to act as market makers. They are structurally limited in how much they can hold on their books.
So there are fewer shock absorbers in the system.
Way fewer. And when selling pressure hits, that reduced capacity creates market air pockets. You get these disproportionate huge price moves on what should be modest volume.
Which makes the entire system pretty susceptible to panic. So given this environment, what's the pain trade right now? Where's the most common mispricing?
The prevailing pain trade is really centered on two big misallocations. First, being significantly underweight the broader equity market, so only being concentrated in mega cap tech. And second, being simultaneously overallocated to long-duration fixed income, making an aggressive bet that Fed rate cuts are imminent.
So the market is positioned for a hard landing, imminent pivot scenario. But the data keeps suggesting this sticky, muddling through economy.
That's it. And if the economy keeps muddling through, if inflation stays sticky and the Fed stays higher for longer, two things will happen. The broader market will likely broaden out, crushing those underweight positions.
And the bonds.
And those elevated bond yields will just keep eroding the capital of the long-duration crowd. It's a double whammy for anyone betting on a rapid pivot.
So we have a structurally fragile, tactically vulnerable market, where the pain trade is fixed on a pivot that hasn't happened. What's the high conviction alpha thesis here?
The thesis is all about dispersion and dislocation. Institutions are avoiding big directional bets. The focus is on relative value.
So capitalizing on that granular divergence we talked about earlier.
Yes. For example, going long, high-quality AI enablers and shorting overvalued, structurally challenged segments, maybe even in the same sector. You're capitalizing on the weakness that the overall neutral headline completely masks.
And that thesis works until one of the structural pivot levels is breached. We need to know those tripwires. What's the first critical signal that would change everything?
First is VIX stress. A sustained move into true aggressive backwardation spot VIX consistently above the futures, especially if spot VIX pushes above 25. That signals an undeniable flight to safety.
Okay. Second would be stress in the funding markets, a liquidity event.
Yes, a sustained spike in overnight funding rates like SOFR or EFFR moving way above the Fed's target. If the cost of borrowing for banks spikes, it means trust between them is breaking down. Liquidity is freezing.
Third, and this goes back to our earlier point on divergence, we'd look for correlation reversion.
Exactly. If the 60-day average pairwise correlation across S&P 500 components rises above a certain threshold, let's say 0.7, that means individual company stories are now irrelevant. Macro is dominating everything.
And dispersion strategies stop working.
They stop working completely. You have to switch immediately to broad directional hedging.
And finally, the ultimate pivot point, the policy pivot.
Clear, unambiguous communication from the Fed, an imminent shift, either aggressive easing because of a crash or a surprise return to aggressive tightening. That just resets the discount rate for every single asset.
This whole deep dive really reinforces the lesson that a neutral market is almost always a facade for rising structural risk and divergence. The sophisticated players, they aren't waiting for headlines.
No, they're focused on micro-level dispersion, tactical stop hunting, and this macro-level liquidity fragility.
So as we wrap up, what's the one provocative thought you want to leave everyone with?
If you take one thing away, consider this. The market's key mispricing is the underestimation of the stickiness and the breadth of core services inflation, and as a result, the underestimation of the Fed's resolve to stay higher for longer than current growth models suggest.
So that persistence is the real risk.
It's the risk that refuses to be tamed, and it's the one most likely to cause the next major sustained dislocation.